3701. This is our lecture 2. This is our lecture 2. So in this lecture, we seek to enhance your understanding by working through a practice question. On absorption costing. Because remember, lecture 1 covered on direct and absorption costing. Costing principles. So lecture number 1, we explained the underlying principles of direct and absorption costing. That was lecture number 1. So in this lecture number 2, we seek to enhance your understanding by doing a practice question. So remember what I said from the previous question. Before you work out through any topic or any module, you need to really understand what is going to be expected of you under that topic in the exam. So under this topic of direct and absorption costing, the question that you're likely going to expect in the exam is for you to prepare an income statement. So you are going to be requested or required to prepare an income statement. And with my knowledge with MAC 3701, most likely this income statement is going to be under absorption. Why do they usually ask absorption and they sometimes ask direct, but mostly you need to pay attention more to absorption costing? The reason being that the principles of direct costing are going to be questioned in other topics. For example, you know direct costing is basically your sales less variable cost, then you get contribution. So you'll find that throughout other topics, you're going to be required to calculate contribution, which means that's you being tested on direct costing concepts. Because whenever there's contribution involved, it means it's direct costing which is being tested. So you find that you're going to come across direct costing when you do your CVP analysis, when you do your transfer pricing, when you do your relevant costing, and various other topics. So you find that when they ask you to prepare an income statement, for them to ask you an income statement under direct costing seems like repetition. So they actually mostly ask you on absorption costing. I'm not saying they won't ask you an income statement under direct, no, but mostly with my experience with MAC 3701, if you look back from the past exam papers, the income statement has always been there, but mostly it has always been under absorption costing. And also the other thing that you need to know is that they are also most likely going to ask you inventory method. The inventory method that is going to be asked is also FIFO, not weighted average, right? So this is what you need to focus on. And then it's very rare for them to really ask you on weighted average cost of, because they've already tested you on inventory methods in MAC 2601. So they are not really focused on testing you on inventory methods. They don't worry about your understanding, or they assume that you really understand inventory methods. So that's why they normally ask you in absorption costing, and and the company will be using first in first out as their inventory method. And then the other thing that you also need to understand is that they can say prepare an income statement, and we say that income statement can be a budgeted income statement. They can request you to do a budgeted, or they can request you to do an actual income statement. I explained in the previous lecture the differences between these two. So in this lecture, we're going to cover a budgeted income statement. Okay, so let's look at the required. So the first thing that you need to do whenever you come across a question is you need to read the required before you read anything else. You need to read the required before you read anything else. The required will give you direction and perspective of how you're supposed to answer the question, because you can't just read information without knowing why you are reading that information. You need to know what you need to use the information for. So we're going to do part A, right? So they said here, prepare the budget. So most students, I have noticed that they don't understand the question. They just rush to answer, but they do not understand the question. So it is very, very important that you understand the question first before you attempt. So the question says prepare. So I'm just going to break down the question. When they say prepare, it means that what? Prepare means you need to do it according to the required presentation, right? You need to do it according to the expected or required presentation. So presentation matters, and we covered this in lecture 1. The presentation of absorption costing was covered in lecture number 1 for absorption and also direct costing. So they say you must prepare a budgeted, right? A budgeted statement. They say you must prepare a budgeted statement. This is important. Why? Because remember, I said they can ask you to prepare a budgeted or an actual statement. So in this case, it's a budgeted statement. So this helps you to narrow down your perspective or to isolate your information. Why am I saying so? Because if you look at this question, here it says note number one. It talks about, it gives you the budgeted information for 2018 financial year, which ends here in 1.6. This is where it ends, right? And then here they now start talking about what? Actual results. Here they start talking about actual results. Note number 2 is actual results. So if you look at these two, it means that since I'm doing a budgeted statement, it means my focus is only going to be on this information going up, which means I'm going to disregard note number 2. I'm only going to focus on note number 1. Why? Because that's where I find my what? My budgeted information. That's where my budgeted information is. That's where my budgeted information is. So that's understanding the question now. So the question is now helping you to isolate information that you need to answer the question. So they say we need to do a budgeted profit and loss, and then for TT, and then they say for 2018 financial year, it is also important that you master the period in which you're supposed to prepare the statement, because a question can actually provide you information of 3 different periods. That is a scenario that covers from 2017 to 2019, and you need to know which period you need to use for each in particular question. They say show amounts for product HT and DT. They're producing 2 products and they need us to do 2 columns. Then the total is not required, which means we only have 2 columns. Total not required. Round all your workings to the nearest rand, and then ignore prospects of making use of ABC costing. Okay, and then like I told you, this carries mostly the weight is 10 to 15 marks, and this is always there in your exam. This question, if you go back to the previous questions from I don't know when, but all previous MAC 3701, you always find a question that requires you to do an income statement, either under absorption or direct. So this is how important this topic is. It's always there in your past exams. So if you want to do your research, go through the past exam papers and you can actually find that this question has always been there. And then we said this is 2018 financial year. We're preparing it for 2018 financial year. So now that we've understood our required, we've mastered everything that we really need to do. Let's go back to the opening information. Okay, so there's always this first paragraph that is given in each and every question. So this opening first paragraph helps you to understand what the company does. It helps you to understand the inventory method being used. It helps you to understand the costing method that is being used. So if you look at this question here, they said Tsanin Trampolines is recently established family-owned company in Limpopo. TT manufactures and sells 2 different types of square trampolines, namely Humpty trampolines, which is your HT, and Dumpty trampolines, which is your DT. Trampoline is becoming increasingly popular all around the country as it serves as a source of exercise and fun at home. TT makes use of absorption costing. So that's the costing method that they're using. We're going to be using absorption costing. And then they say all its inventories are valued using first in, first out, FIFO method, right? So we know that this is absorption costing here. And then they said we're using what? FIFO as well. So it's absorption costing and FIFO. And then they said we must actually do a budgeted statement. And this is for 2018 financial year. This is for 2018 financial year. Okay, so let's start looking into the question. So if you remember from our previous lecture, right? Okay, so this is from our previous lecture, if you still remember, lecture number 1. So we actually got to cover this information. We explained how you're supposed to present a budgeted statement under absorption costing, and this is it, right? This is it. So we explained how you're supposed to do a budgeted statement under absorption costing, and then this is what we expected to do. This is what we expected. So the question is requested us to do this part here. So this is what we need to have at the end of the day. So this is what is required of us. It's a budgeted statement and absorption costing. So we start with our sales, go to cost of sales, and do everything as we explained in lecture number 1. So this is the expected statement in this question. Some statement. We are doing a budgeted income statement, and we said that this is absorption, as stated in the information, and we said we're using what? FIFO inventory method is for 2018 financial year. Okay, and it's for TT being the company. So this is what we need to do. So actually, if you look at the required, they said here, if you look at the required, right, this is the required. They said we must have 2 separate columns, right? We must have 2 separate columns. You must have 2 separate columns for HT and DT, since the company is producing 2 products, which is HT and DT. So you're going to have our 2 columns here. Okay, so it is important that you know how to isolate your information. So we start with our sales. So I don't need to read all the information on this question so that I can start. No, I can actually write sales. Then I need to look for the information that pertains to sales only. I need to look for the additional information or for the notes that pertains to sales. I don't need to read the whole information, because by the time you get to the required, you would have forgotten what you have read actually. So it is important that you work with isolated information. So the question actually gives you isolated information so that it becomes easy for you to work throughout. So they've told you that sales, right? If you can check here, sales are mentioned here, 1.2, note number 1.2. That's where they mentioned sales. So what do they say about sales? They say TT budgeted to sell 24,000 trampolines in the standard sales mix of 1:3. So in total, we must sell 24,000 trampolines, right? In the standard mix of 1:3. What this ratio means that for every 1 HT that I sell, I also sell 3 DT, right? So if you add these two, it means that we have 4 products. 1 plus 3 equals 4, right? It means we have 4 as our total. Then they say the standard selling price for HT and DT was set at 8,000 and 3,000 respectively. Okay, so we've got the selling price, we've got the units. So you know that for you to get your sales revenue, for us to get this amount here, we must say it's sales units multiplied by selling price, multiplied by the selling price. So for us to calculate the sales units of HT. So for HT, it means that for HT, I'll have 1/4, not 1/3. It's 1/4, because you have to add whenever you're given a ratio. For you to get the denominator, you must add 1 and 3. You must add the numerator so that you can get the denominator that you're supposed to use for that ratio. So 1/4 of 24,000 equals to 6,000 units. And then for DT equals to what? Equals to 3/4 multiplied by what? 24,000. Then you get 18,000 units. So these are units. These are sales units. But for us to get the revenue, we need to say what? Sales times selling price. Sales units times selling price. So in this case, I'm going to say for HT, means that for HT, the selling price or the sales revenue is going to be 6,000 multiplied by what? By the selling price, which is what? 8,000 is given here. And then for DT is going to be what? 18,000 multiplied by 3,000 selling price given. So here it means that I'll have to say 6,000 times 8,000, which is going to give me, let me just calculate quickly. It's going to give me 48, right? 48 million. And this one is going to give me 54 million. So I take these amounts. This is my 48. This is for HT, sorry. And then this is for DT. You need to label that. HT and DT. My sales is 48 million and 54 million as well in this case. And then I need my cost of sales, of which my cost of sales are not given. I need to calculate them. How do I calculate cost of sales? I start with opening inventory. So do I have my opening inventory? So I have to look for the note that talks about opening inventory. If you look at this question here, this note number 1 is the one that talks about inventory and manufacturing, right? So it means my inventory and my manufacturing units, I have to get them on this part. I don't need to read the whole information. I just need to go specifically to the information or to the note that I need at each and every particular point when I'm answering the question, than for me to read everything and forget again. Okay, so here they said the company had no budgeted opening inventory and no budgeted closing inventory, which means opening inventory is 0, closing inventory is 0. Automatically, this means that whatever that is produced is going to be sold. Whatever that is produced is going to be sold. And they say for all types of inventory. So when they say whatever that is going to be sold is going to be, whatever that is produced is sold, it means that the sales units and the manufacturing units are equal. The sales units and manufacturing units are going to be equal. So they say to minimize possible wastage during the financial year, the company budgets to manufacture the trampolines in direct proportion to its standard sales mix. The budget manufacturing levels for 2018 financial year were equal to the company's normal operating capacity. Okay, so what this means that if I don't have opening inventory and I don't have closing inventory, it means that my sales units are going to be equal to my manufacturing units. It means that sales units are equal to manufacturing units or manufactured units. Does it make sense? So it means that HT is what? We said it's 6,000, and then DT we said it's what? 18,000. So this is also going to be my manufacturing units. Okay, so opening inventory, we don't have anything. Now let's go to manufacturing, direct material, direct labor, and variable manufacturing overheads. Okay, let's look at the information given now. Do we have our direct material? Okay, so here if you look at this question, they said here on note number 1.3, they talked about variable cost, which means this does not cover fixed cost, it covers only the variable element. Okay, so variable cost, trampolines consist mainly of 4 basic components: which means we have 4 raw materials, right? Which is your tubing, your steel springs, your jumping mat, and your safety pads. So these 4 are going to be my direct material. That is the tubing, steel springs, jumping mats, and safety pads made of foam. The tubing used to make the frame. So this process here is just simply explaining you the manufacturing process of trampolines. I'm not going to worry much about that process. Then they say TT employees, factory workers, direct laborers who operate various manufacturing machines. The standard is to allow 10% idle time. You don't need to worry about idle time. You need to use this one for standard costing. This is going to be used for standard costing, which is a topic that we are yet to explain. Then standard variable requirements for 1 HT and 1 DT. So this is standard number 1, which means this is the budgeted, and it is variable cost. So this is only variable cost, right? So they explained to you so they did not give us the cost per unit, but they give us the requirements in terms of material, and they also gave us the price of each and every material per unit. So it means that we need to calculate the cost of HT and DT per unit. So it is wise that I start by calculating the variable manufacturing cost, right, of each and every DT and HT. So here I need my variable manufacturing overheads. So since I can't really do this within the frame, right? I can't do this within my frame here. It means I need to do it under calculations, and always reference your calculations. Always make sure that you reference your calculations. I forgot to reference the calculation for the cells, but I'll just do it just now. So this will be my calculations. So under my calculations, I have calculations for cells, and then for cells we said that for HT it was 1/3 multiplied by 24,000, and then you got 6,000, and then you multiply by the selling price of 8,000. That's how we got 48 million. Then for DT we say it was 3/4 multiplied by 24,000, and then we got 18,000. Now 18,000 times it was 3,000, we got 54 million. Okay, so this was the sales part. So C number 2 is going to be calculation of variable manufacturing overheads. So let's look at the information on variable manufacturing overheads. So I'm going to do it for HT, and then I'm going to do it for DT, right? Okay. So what did they say? They said tubing, right? So on tubing, they said tubing is 150 per meter, right? But I need 24 meters. So it means that the total cost is going to be 24 meters multiplied by price per meter, right? Which gives me 3,600. Then I have got steel springs, which they said 5 rand per spring, yet I need 110 springs. So to manufacture 1 unit, I need 110 springs, of which 1 spring is costing 5 rand. So the total to produce 1 unit is going to be the total cost of 110 springs, which is 550. Now I have got jumping mat. They said here it's 50 rand per square meter, yet I need 4 square meters. So it's going to be 4 multiplied by 50. 4 multiplied by 50. So you will find that 4 multiplied by 50, I get how much? 200. Yep, 200. So you find that in MAC 3701 you do deal more with conversions, meters, square meters, liters. You need to be very, very comfortable in knowing these conversions, right? Weight, in terms of space, and other conversions that you might be required to work with. Now safety pads, They said safety pads is 1 rand per safety pad, and yet I need 110 safety pads. So 110 multiplied by 1, which is 110 on 10. Now they talk about direct labor. They said 100 rand per direct labor working hour, yet I need 8 working hours, right? I need 8 working hours. So it means in terms of direct labor, the cost is going to be how much? I need 8 hours, and 1 hour is costing 100 rand, which means the cost is going to be 800. Now let's go to variable manufacturing overheads. Variable manufacturing overheads. They said the variable manufacturing overheads is 10 per machine hour, yet I need 6.5 hours. So it's going to be 6.5 multiplied by 10. That gives me 65, right? Yes. So the total of this is going to be 5, 3, 2, 5, right? So why did I ignore variable selling and admin? Because this is not a manufacturing cost. Remember, absorption costing, it seeks to first subtract manufacturing cost, then non-manufacturing cost comes after gross profit. So this is not a manufacturing cost. This does not form part of cost of sales. It's a non-manufacturing cost. Remember, we explained that there are costs that are incurred in the factory and costs that are incurred in the office. If you look at these first ones, this is what we incur in the factory. You can't have a product without incurring these first costs, right? But you can have the product without variable selling and admin. So variable selling and admin is not required in the manufacturing of the product, but is required in the selling of the product. So this is incurred in the office. So that's when we explain that we only need the manufacturing first, then the non-manufacturing is going to be subtracted after gross profit. We explained that in lecture number 1. So this is going to be the what? The variable manufacturing overheads. This is per unit, right, of HT. Now let's do for DT. It is going to be the same procedure again for DT. Means that I'm gonna have to start with tubing, which for tubing now this is 6 meters required, and yet 1 meter is costing 150, which gives me a total of 900. And then I have steel springs, which is they need 80 springs to manufacture one DT, multiplied by 1 spring costing 5 rand. So my total cost for 1 unit of DT is going to be 400. Then I've got jumping mate. We said here how many square meters are required is 3 square meters required, multiplied by 1 square meter costing 50 rand. So I'm going to have a total cost of 150. Then I've got safety pads. How many are required here? 80 safety pads, and each safety pad is costing 1 rand. So my total is going to be 80. Now in terms of direct labor, they said here 100 rand per direct labor hour, and yet DT requires 4 working hours now, not 8. It requires 4 working hours. So it's going to be 4 multiplied by 100. Then I have 400. And then variable manufacturing overheads. Variable manufacturing overheads. What do I have here? I have 10 rand per machine hour, and yet this time now DT requires 5.5 hours times 10, which is going to give me 55. So it means that the total of this is how much? 1985. 1985. So these two amounts are the variable manufacturing cost. Variable manufacturing cost. Variable manufacturing cost of DT and of HT. Of DT and of HT. So this is my working number. This is my calculation number 2. This is my calculation number 2. This is calculation number 1 for the cells. So what I need now is that I need to know how much was the variable manufacturing cost. So it means I have to go back to my statement here. Remember, I included variable manufacturing cost, variable manufacturing cost is supposed to come here. So if you look at these amounts here, we said for this one now it's 53525 for HT. But how many units of HT did we produce? We produced 6,000. So it means now I need to get the total for HT equals to 6,000 units. Remember the 6,000 units that we said are going to be manufactured, right? 6,000 units multiplied by 5,325, right? And then for this one, let me see, what is the total here? It gives me a total of 31,950,000. Okay, so that's the total that I need to take to my statement. And then for DT, it's going to be 18,000 units multiplied by 1985. 18,000 units multiplied by 1985, which gives me a total of 35730. Okay, so how did I know that I manufactured we manufactured 6,000 and 18,000 units? Remember what we explained from note number 2 here, that we explained that because of this statement here, right, which says that manufacture, okay, first of all, there was no opening inventory and no budget closing inventory, which means that whatever that you produce, we're going to sell all of it. So it means that your manufacturing units are going to be equal to your sales, right? And also they said that manufacturing of trampolines is in direct proportion in the standard mix. So which means that whatever that we're going to manufacture, we are also going to sell. So it means that the manufacturing units were equal to the sales units. Manufacturing units were equal to the sales units. That's why we said manufacturing units, if the sales units was 6,000 for HT and 18,000 for DT, it means that were also going to be the budgeted manufacturing units. That's why when we got here, we were calculating the variable manufacturing cost, right? We were calculating the variable manufacturing cost per unit, right? And then when we got the variable manufacturing cost per unit, which was this amount, we had to multiply it by the total units to be manufactured so that we can get a total variable manufacturing cost for the two products, which are these amounts. So we need to transfer these amounts to our statements now. To our statement, which means here I have 31,950, and then here I have 35,730. Okay, so I've done the variable manufacturing cost. So the variable manufacturing cost, this amount, it includes what? It includes direct material, as you can see. It includes direct labor. It also includes variable manufacturing overheads. So this amount here is included in this amount. So all these three elements have been included in one amount. So this is according to this question. You could have shown everything separately by writing tubing, steel springs, jumping mat. It's fine. You could have shown everything in the statement, right? But I always prefer to calculate the manufacturing cost per unit separately and then coming back to multiply it by the total manufactured units. So direct material has been done, direct labor has been done, variable manufacturing overheads have also been done. They've been included in one amount because the information allowed us, this information here, it allowed us to calculate it as one amount. And then we excluded variable selling for the reason that I've explained. It's not a manufacturing cost. right? So once I'm done with this, I need now to calculate my fixed cost. I need now to calculate my fixed cost. So what did they say about fixed cost? It means I'm going to jump everything and go to fixed cost. Fixed costs are covered on note number 4. Fixed costs are covered in note number 4. Fixed costs are covered in note number 4. So this is my fixed cost. So let's see what they say about fixed cost. TT uses top of the range machines that bend and punch holes in the tubes. Okay, so this whole information is just an explanation of why we have the fixed cost. Okay, I think I'm more interested starting from here. Budgeted fixed manufacturing overheads of 5,000, right? So it's not 5,000, it's 5 million. For 2018 financial year, we allocated to the products based on budgeted direct labor working hours. Based on budgeted direct labor working hours. So it is important that we know that they're going to vary using what? Budgeted direct labor working hours. So what they're simply saying is this: we must use direct labor working hours as a basis to allocate the total fixed cost. So remember that we were given one amount for the fixed cost, right? We were given one amount, which is 5 million, but we need to separate this 5 million between the two products. And the basis for doing that, they said we must use direct what? Labor working hours. Direct labor working hours. So we now need to know which product took more hours. So the product that took more hours to produce is also going to take more hours in terms, it's going also to incur a greater cost in terms of the 5 million, right? So let's look at this information here and calculate how are we supposed to allocate the 5 million. How are we going to allocate the 5 million? Okay, so this is the information that we have here. This is the information that we have. So here they said the total cost is 5 million. So we need to allocate this 5 million between the two products, and we're going to use direct labor working hours, right? Okay, so whenever you're faced with this question here, you need to calculate number 1. So this is going to be my C3 fixed cost, right? Okay, so you need to calculate total hours for each product, right? For each product. You are not going to allocate based on 8 and 4 to say 8 plus 4, then you get 12. Then you say 8 over 12 times 5 million. That is wrong. Why? Because you are doing it per unit. You must do the total hours for each product. You must calculate the total hours for each product. So the allocation has to be on the total hours. And they've actually told you that this is the total annual normal manufacturing capacity of the factory was equal to the budgeted annual working hours, right? So this is budgeted direct labor hours. So we need to know how many hours in total are going to be allocated to HT and how many hours in total are going to be budgeted for DT. Then that becomes the allocation base. Okay, so let's look at this. How many hours do we need for HT? Let's look at hours needed for HT. The hours that are needed for HT. We need 8 working hours. It's actually stated, right? So for HT, 8 working hours are required. And how many units are we going to produce of HT? We're going to produce 6,000 units. So in total, how many hours are we going to spend in the production of HT? We're going to spend 48,000 hours. Then for DT, how many hours? We need 4 hours per unit. This is it. These are the hours required. These are the hours required, right? Given here, 8 hours and 4 working hours. But how many units did we produce here? For HT, we produced 6,000. We produced 6,000 units. And then for DT, we produced 18,000, if you remember very well from calculation number 1. Now, this is what we have. 4 hours times 18,000 units, right? So this is hours. This is units, and then this gives us the total hours. This gives us the total hours. So we have 72,000 here hours. So this becomes the basis, right? So which means in total we're going to spend how many hours? If you add 72 plus 48 equals 220,000 hours. So it means that the cost of 5 million is a cost for how many hours? 420,000 hours, right? So it means that when I'm now allocating the 5 million, I have to say for HT, the cost that is supposed to go to HT is 48,000 hours over 120,000 hours. So this becomes a ratio, right? From here, I have to generate a what? A ratio to allocate, or an allocation base. Okay, so 48 times 5 million, I get 2 million. And then for DT, it's going to be 72 over 120,000 multiplied by 5 million again, and then I get 3 million. So this is how the cost is going to be allocated to the two products, HT and DT. Okay, so let me post this to my statement. And also remember to reference your workings, right? We said this is calculation number 1, and then we said this was calculation number 2, and then this is calculation number 3. Okay, so it is important so that when the examiner is looking at your work, they can reference the work, and then they can allocate the marks, because remember it is the workings that carry more marks. 2 million and 3 million. Okay, so this is what we have, 2 million and 3 million. So that's the fixed cost. So the next thing here that we need is the closing inventory. We need to subtract our closing inventory. So the closing inventory is supposed to be in brackets, but we don't have closing inventory. If you remember, they mentioned that on note number 1.1. Note number 1.1. It was mentioned, note number 1.1, no opening inventory and no closing inventory. Here, no opening inventory and no closing inventory. So this is new, and also we don't have closing inventory in this case. Okay, so this is how our cost of sales was supposed to be calculated. This is how our cost of sales was supposed to be calculated, right? So this is how. So in addition of this, so all this was calculation of cost of sales. This was calculation of cost of sales. All right, so it's opening inventory plus current production cost. These two, they form the current production cost less closing inventory, right? And we have our cost of sales, which is going to be, if you say this plus this 31950 plus 2 million is going to give you 33,950. That's my cost of sales, and then the other amount is 38,730. Okay, so this is it. So that's my cost of sales, and then after this, what we need to do now is to say sales less cost of sales. Then I get what? Gross profit. Sales less cost of sales to get gross profit. So this sales less cost of sales equals to the gross profit, and then the gross profit that we get for HT is 14,050, and then the other one is 15,270. Okay, so this is your sales here less your cost of sales. Your sales less your cost of sales. Okay, then you get your gross profit. After your gross profit, that's when you have to now put less non-manufacturing cost. Non-manufacturing cost. So my non-manufacturing cost is going to come here, and then I have to calculate it because it won't be readily available. I have to calculate the non-manufacturing cost. I have to calculate the non-manufacturing cost. So I have to look at the information. Where did they mention non-manufacturing cost? Where did they mention non-manufacturing cost? Okay, so the first non-manufacturing cost that I can identify is here, right? Let me just remove the other part. Okay, this one. Okay, variable selling and admin, right? This is a non-manufacturing cost, and they said it's 50 rand per unit. It's 50 rand per unit. So how am I going to calculate it? Variable selling and admin cost, right? I have to say for HT it was how much? It was 50 rand. So it's going to be 6,000 multiplied by 50. That's for HT, because if they say it's 50 rand to sell 1 unit, then I had to sell 6,000 units of HT. And the other thing is that variable selling and admin, they always vary with selling units, not manufacturing units. They always vary with selling units. So 6,000 multiplied by 50, 6,000 multiplied by 50, that's 300,000. And then for this is for HT, and then for DT it was how much? 18,000 units multiplied by 50, which gives us 900,000, which gives us 900,000. Okay, so that's your non-manufacturing cost. And then there was the variable part. Then let's look at, did we have any fixed non-manufacturing cost? Did we have any fixed non-manufacturing cost? Okay, so here it is, right? Fixed cost, right? Under fixed cost, that's where we're likely going to get the information. Okay, so what did they say here? They said this important here. So these ones were manufacturing, right? We've dealt with these ones. These ones we said they were manufacturing. We've dealt with them. Now let's look at this. The company's budgeted annual fixed. The company's budgeted annual fixed selling and admin expenses for 2018 financial year is 120,000, and they were allocated to products based on budgeted number of units sold, which means that I have to allocate them based on what? Budgeted number of units sold, which means to allocate this I need to say 120,000 multiplied by what? For HT, this is for HT, it's going to be 120,000 multiplied by 6,000 units. Remember, for HT I sold 6,000 units out of how many units? 24,000, right? And then for DT, how much do you get if you do this? So the fix is going to be 30, right? 30,000 here. And then for DT, it's going to be 120,000 again, multiplied by what? 18,000 now, because I sold 18,000 units of DT over 24,000 equals to 90,000. So this is how it's supposed to be calculated. So it means here I come back to my statement. I had the variable selling and admin here. Now I need the fixed selling and what? And admin cost, which we've already calculated, and we said is 30,000 and 90,000. 30,000 and 90,000. Okay, so this is what comprises of my non-manufacturing cost. This is what comprises of my non-manufacturing cost, right? This is my non-manufacturing cost. So it means that I have 330,000 here, and then here I have 990,000. as my non-manufacturing cost. These are the costs that are not involved in the production cost, in the production process. But if you look at this information here, if you look at the information that I've been given, there's also note number 1.5 and note number 1.6. These ones, they relate to, that's insurance and administrative staff cost. These ones, they relate to other operating costs. These are called other operating costs, and I have to subtract them as well. Other operating cost. Other operating cost. Okay, so let's calculate the other operating cost. What did they say about other operating cost? What did they say about other operating cost? Okay, so other operating cost, I'll go to my calculations. I think I have them either here from this side. Okay, let me remove this. Okay, insurance, right? The company has taken out third-party insurance with Sky Insurers for possible litigation that might arise for improper and unsafe use of the trampolines by customers. The insurance premiums have not yet been determined with certainty for the 2018 financial year. Indications that the fixed component of the premium is expected to be 25,000 per month. 25,000 per month, right? So the fixed premium is 25,000 per month, and it is allocated equally to the products. So it means that we have to calculate for the whole year and divide by 2, right? So it means that the fixed insurance, in terms of insurance, okay, the total is going to be 25,000. Because it's per month, we're going to multiply by 12, right? Because it's per month, we have to multiply it by what? By 12. And then if you multiply by 12, you get what? 300,000, right? Now for HT, we're going to say, since it's going to be allocated equally, right, between HT and DT, which means that it's going to be that 300,000, which is the total fixed, multiplied by what? By 50%, or 1/2, which is 150,000. And then for DT as well, is 300, same calculation, multiplied by 50%, or 1/2, which is 150,000. Okay, so it means that I can actually bring it to the statement and say insurance cost, fixed insurance, it's 150, and 150,000 as well here for the 2 products. Now let's continue working with this. Okay, so they said here, the variable component is based on the number of budgeted sales units and the possibility of insurance cost per sales unit. For HT, there's a 10% probability of 30 Rand per unit sold, 20% probability of 15 Rand per unit sold. So it means that since I've been given probabilities, I have to calculate the probable outcome, right? I have to calculate the probable. Whenever you're given probabilities, you must calculate the expected variable insurance cost. You must calculate the expected outcome. So it means that for, let me start for HT, right? I'll have the probability here. And then I'll have the cost here, right? And then I'll have the expected outcome. Okay, so it means for HT, right? They said here is 10, there is 10% probability of 30 Rand. So it means I'm going to say 10% multiplied by what? By 30 Rand. It gives me 3 Rand, right? Then It simply means that if there's a 10% probability chance, it means that the cost is what? Is 3 rand. Then here they said is 20, there's 10% probability for 30 rand, there's 20% probability for 15 rand. So it's going to be 20% multiplied by what? By 15 rand, which is going to give me 3 rand again. And then they said here 25% probability of 40 rand. 25% probability of 40 rand, which is going to give me 10, because if I say 25% of 40 rand equals to 10. Then the last one, which is they said here then 45 probability of 20 rand, 45% probability of 20 rand, 45% multiplied by 20, 45% multiplied by 20 rand, which gives me 9 rand. So in terms of the total, right, expected outcome, I have to add this, it gives me 25. So 25 rand is the expected cost per unit of insurance, the variable expected cost per unit of insurance. But how many units? And this is per unit. You must remember that this is per what? Per unit. Remember, they've actually stated here that this amount is per what? Per unit. It's always per unit sold, per unit sold, per unit sold. So which means I need to multiply it by what? By units sold. I need to multiply it by units sold. Okay. How many units were sold for HT? 6,000 units. So 25 multiplied by what? By 6,000. It gives me 100 and what? And 50,000. 150,000. That's the expected cost in terms of variable insurance cost. That's the budgeted variable insurance cost. Now, for DT, same procedure again, right? We have the probability here, and then we have the cost, and then we have the expected cost per unit. So they said here for DT, it's 15% probability for 20 rand. So there's 15% probability that it's going to be 20 rand. Then they said here there is 25% that is going to be 25%, that the cost is going to be 40 rand. Then they also say that 40% probability that is going to be 30 rand. 40% probability that is going to be 30 rand. Then the last one they said here 20% probability that is going to be 10 rand. 20% probability that is going to be 10 rand. So 15% times 20, 15% times 20, which is going to give me 3. Then 40% times 40, sorry, 25% times 40, 25% times 40, which is 10, 40% times 30, which is going to be 12, and then 20% times 10, which is going to be 2. Then adding this is going to give me 20 what? 27. And then how many units? Units sold. Because remember, this is cost per unit. Units sold, units ought to be sold, they were 18,000. So it's going to be 18,000 multiplied by what? By 27, which is going to give me 486,000. So I've already calculated my variable insurance cost. This is how the variable insurance cost was supposed to be done. So if you look at this, whenever you're given probabilities and possible outcomes, this is how you're supposed to work out, right? This is how you're supposed to work them out. You simply take the probability percentage, multiply it by the what? By the cost, and then you get the expected cost per unit. And then in total, we have 150,000 and 486,000. So we take it back to our main statement. It's 150,000. So this is the variable portion of insurance. 150 and 486,000. 150, then 400 and what? And 86,000. Then that was note number 1. That was note number 1.5. That was note number 1.5. Let's look at note number 1.6. What did they say on note number 1.6? So 1.6 is very straightforward, right? 1.6 is very straightforward. They said fixed administrative costs are budgeted, right, at 1,200,000 for each year, of which 1/3 is allocated to HT and the remainder to DT. So this is quite very straightforward. So it means I'm going to say for HT it's going to be 1/3 multiplied by what? 1,200,000, which gives me 400,000. Then for DT it is going to be, if I allocate 1/3 to HT, which means the remainder becomes 2/3 times 1,200,000. Then that gives me 800,000. Okay, so these are the amounts that are required in terms of administrative costs. So you must also remember that you need to number your calculations. This could be my C4, right? Fixed admin. So it's administrative staff cost, sorry, administrative staff cost. Admin staff cost. So I post it back to the statement: 400,000 and 800,000, 400,000 and 800,000, 400,000 and 800,000. Okay, so this is fixed admin staff cost. It was 400,000 and 800,000. So let's also, these also need to be added. These also need to be added. You also need to add them. Okay, so adding up, they must come here and be subtracted here. So it means I have 700,000 here, and I also have 1,436,000 here. Okay, so that's what we have. So that's other operating cost, and we said this was non-manufacturing cost. This was non-manufacturing cost. Okay, and then this was cost of sales. So this is what we have now. So if you subtract now, if we say our gross profit, this gross profit here, this gross profit here, less non-manufacturing cost, which is this one, less other operating cost, that gives us our what? Our net profit. That gives us the net profit for each. So it's going to be this 1 million, it's actually 14,050,000 less 40,050,000 less 330,000 less 700,000, which gives us an amount of 13,020. So it's 13,020,000. Then for product DT, same procedure again. The gross profit, this one, less non-manufacturing cost, less other operating cost, it gives us 12,844,000. Okay, yes, so this statement is what was expected of you. This is what was expected of you. So this is the statement which they wanted you to prepare. All right, and then remember that also it is the workings that we were doing here that have got marks, and always remember to reference your workings like what I was doing here, C1, C2, and take it back to the statement, and also make sure that you have your C1 here and you also have your C2 indicated here in the statement, so that when the examiner is marking your work, when they look at cells, they go to C1 and they see how you worked out the cells, and then you can get total marks for your correct calculations. Okay, so this is one particular example of how to do a budgeted absorption costing statement. Okay, so just a recap of the procedure or of the process that you need to take. So remember what I said, right? First of all, when you're faced with this question, remember I told you this question is very, very important. You're going to have it in your exam. You're going to have it in your exam. There's always going to be absorption or direct costing statement that you need to prepare at some point. You might not be required to prepare a statement, or they might say calculate gross profit, but you find that it's one and the same thing, because for you to get the gross profit, you need to apply the principles of absorption costing, or they can say calculate contribution. It's still the same thing. For you to get contribution, you need to apply the principles of direct costing. Okay, so the first thing, like I told you, is to read the required. When you read the required, understand the required. Are you required to do a budgeted, or you're required to do an actual? And also understand which period is it, right? And then also, after you do that, you must read always. There's always going to be the opening statement, right? There's always going to be an opening paragraph, which is this one. So this one is where you can actually get to know the inventory system of the company, and then that's when you can get the costing method, which is either absorption or direct, right? After you do that, then you go straight to your statement. You start doing your statement already. You start on your statement. You start writing sales. Then when you write sales, you then look for the information that pertains to sales. You don't need necessarily to read the whole question, right? You don't need to read this whole question for you to start answering. No, you just need to read the first paragraph, which introduces you to the company and the product and what they do. Then after you have an understanding, a comprehension of what the company does, what they do, what they produce, and then in the quantities or the unit that they produce, right? Then when you know that, you can start already with your sales, so that when you go to your sales, you only have to look for the information that pertains to sales. In this case, it was this part here. It was 1.2, not number 1.2. So I only have to read 1.2 for me to be able to calculate my sales. So there is no need for me to read the whole question, because by the time I get to the last statement, I would have forgotten everything, right? So this is how you work with an absorption costing statement. You must isolate your information, narrow it down to the information that you need at each and every particular stage of answering the question, or at each and every line item of the income statement. So each and every line item will have the relevant note. So read only that note, or work with that note only at that particular point in time, than for you to read the whole information is about. Okay, so that is what you were supposed to do. So your sales, less your cost of sales, and then we didn't have opening inventory in this case. And then what we did here in terms of adding variable manufacturing cost, it was easy for us to add the variable manufacturing cost. Why? Because the information was given in that format as well. So it also means that you must be flexible in terms of calculating your, or in terms of working it out. You could have listed the line items to have a line item in the statement for tubing, for steels, for jumping mat, for safety pads, for direct labor, for variable manufacturing overheads. It was still going to be correct, but you're going to take more time than for you to simply calculate it per unit, add the total. Once you have the total per unit, then you multiply it by the number of units, like what we did here. We just calculated the variable manufacturing cost per unit by adding all the elements. Then we got the total per unit. Then we multiplied it by what? By the number of units manufactured. Same as for DT as well. That's exactly what we did, right? That's exactly what we also did for DT. I hope that's clear. Okay, so this was the practice question. So the next lecture, we're going to cover an actual income statement, right? Actual income statement.